Hi, a very good afternoon to everyone. Once again, thank you for attending today's lunchtime webinar on Malaysia Market Outlook Q121. So today we have invited our special guest speaker, Mr. Koh from Kenanga Investment Bank to share with you more on the Malaysia Market Outlook. So before I get started, just want to let you know that we have a Q&A session after the presentation. So if you have any, please feel free to leave your questions at the Q&A session found at the bottom of your screen. Yeah, and Mr. Koh will take some questions from there. But do note that we only take questions in the Q&A box. So do ensure to type in your questions there. Okay. Yeah. And without further ado, let's welcome Mr. Koh. Mr. Koh, over to you.
Thank you, Elena. Thanks. Okay, let me get my slide on the screen first. Okay, wait a minute. This is it. Can you all see the screen?
Not yet.
Not yet, excuse me. Give me a second.
Okay, sure.
Okay, share the screen. This is it. Stop share.
Yeah, Mr. Koh, I can see your screen now.
Can you see?
Yeah, I can see.
Okay, good. Thank you. Let me blow it up. Give me a second.
Okay.
All right. Good afternoon, everyone. Thank you, Phillips, for inviting me over to share Kenanga's take on the market in 2021. It's a pleasure to be here. I hope you're well and happy. Greetings from KL. Okay. The flow of this presentation will be as follows. I'm going to talk about the strategy, the macro stuff, the investment themes for the KL market and economics before I delve into some of the sector pieces which we like. So depending on the time, I suppose I would talk about at least a couple or three sectors that are of interest. These are the sectors that we have an overweight calls on. Okay, first off, overall market outlook for the equities in Malaysia is, to us, looking quite positive. For this end of the year, we are looking at a target for the KLCI at 1711. The CI is now resting at about 1610 or thereabouts. So the basis for this rather positive outlook is really down to the vaccine. Our optimism that this vaccine is going to be a positive game changer for the economy and markets worldwide. Obviously, the impact of the vaccine is not felt, at this point in time. In fact, in Malaysia at least, we are looking at horrifying numbers, daily cases rising. We are now charting about 3,000 over, whereas last year it was just in the hundreds, right? And also, I'm sure you've heard in the West, the number of cases actually is rising as well. So we are looking at a better later part of the year, really, when most of the countries around the world would have been more done with in terms of getting their populations vaccinated. And I think we'll see the impact more fully felt probably in the late part of the year or early next year. And when it comes down to the themes, if you want to frame the KL market in terms of themes, then we have three recommendations. One would be that we believe that this liquidity is very ample in Malaysia, and one that will continue even into next year. So as you all know, liquidity is highly essential in order for markets to move northwards. The second theme is that we believe that in the midst of interest returning back to emerging markets, that Malaysia will be a market which foreigners will consider to put their money in. I think we are probably a contrarian on this view, but let's see how it goes as the year progresses. We believe that there'll be interest simply because I think we've underperformed for so long, and on a lot of measures we are very, very cheap as a market. And then the third theme would be a very simple one. It is that last year's COVID victims, the ones that have been bashed the most, will play catch up this year when the recovery, the recuperation from this mess starts to show. So let's firstly review some of the major observations or experiences that we went through last year before we go into 2021. Very quickly, in 2020, people who follow Malaysian market will realize that although the benchmark was up just about 2%, and by that, in 2020, Malaysia was probably one of the best performing, markets in Asia, thanks to rubber gloves a lot. A lot of that is because of rubber gloves. If you remove rubber gloves, right, I don't think we see 2%. Our estimate is probably -6%, if not for the fact that rubber gloves did so well last year. So it was a very, very narrow market. The rise in the CI masked a lot of underperformance of a lot of sectors. But the ones that shine last year were healthcare, of which rubber gloves was a main component, and technology. Technology was actually none of the technology stocks are in the CI, right? The technology were really, really a good sector last year that drove the especially the small cap index and also the mid caps, the FBM 70. So in a way, the one that did the heavy lifting was actually healthcare and a handful of industrial stocks, which was like press metal, and that only happened towards the end of the last year when aluminum prices started to recover in a big way. And also a little bit contributed by Pacific Chemical. So it was really a very, very narrow-based a very narrow-based rise in our market last year. You look at all the other sectors, right? Compared to the CI is charted by the blue line here. Transport, consumer, those were really, really bad laggards. And finance only started to perform after November 15, I think it was, when Pfizer announced the breakthrough. Finance just shot up, but still ended the year slightly below the CI. And the deep laggards are the energy, oil and gas. Last year, we never imagined that Brent could be negative, could go to negative. Construction was a very bad victim, very, very slow down in activity. REITs, a lot of our REITs are represented by malls, and malls are still like quite empty actually, and even at the moment. Property were a lot of launches were delayed. People were not going to showrooms, So a lot of things were really, really bad last year. But going to this year and next, what's going to happen? Let's look at FY20. Okay, 2020 is over, but then we have one more quarter of results that will be released in February next month. We'll end the 2020 season next month. Excuse me. And we are projecting the EPS for the KLCI. This is the 30 component KLCI. We're expecting the FBM KLCI to yield an EPS of 74.1 cents. And that is a 22% drop from 2019's 95.5, right? So yeah, it was a bad year, but I think this is a year to be forgotten. I'm not sure whether the fourth quarter results will be of any great relevance or significance, but I think what we'll be hearing very closely, we're monitoring very, very closely, would be the guidance by the corporates, especially the banks. Banks, I think there's last year was very bearish, but I think fund managers, half the camp are like slowly beginning to be more bullish. But the ones that are a little bit guarded are people who are concerned over the extent of impairments that could show later. So you'll be hearing very closely to what the bankers are saying in terms of credit costs, but we believe that clarity will not emerge until maybe May, because I think we will take the March results, the March quarter, to show a bit more color. Yeah, so 22% contraction in last year, but this year we are expecting a rebound, a V-shaped rebound. We are expecting 43% EPS growth from 74.1 cent to 106. So and 106 is actually higher than 2019's 95.5 cents. So what's going to drive the EPS growth of 2021? Well, the main components of the CI, the heaviest weightage is contributed to by the banks. And for 2021, for this year, we see the banks delivering earnings growth of 26%. Yeah, and that's on the back of, we won't see this jump so early in the year. I mean, this earnings is going to show more, obviously, probably in the second half of the year. But that's coming from, we believe, improvement in net credit costs. See, a lot of banks in the third quarter of last year, and also we've been pre-warned for this fourth quarter results, they are going to do a lot of preemptive provisioning. So loading a lot of the credit charges into fourth quarter, and that's not a bad thing, because at least going to this year, the provisions, the impairment costs will not sort of be a weight on earnings. And I think bankers know that, so they'll probably be very preemptive. And then if and when the economy improves, we believe that loans growth will start to pick up again. Loans growth has been, the better banks are doing about 5%, but normally it's about 3-4%, which is actually quite sad. But I think loans growth can actually improve as the economy improves. That's the other source of growth. And yeah, NIMs as well. Last year, banks net interest margins were squeezed by continuous cut in OPR, the operating rates, so OPR, the lending rates, basically interbank lending rates, by the central bank. As a result, the NIMs are squeezed quite badly. So that's going to reverse this year once OPR cut stops. And the other source of contributor to growth will be the rubber gloves. Again, last year was good, but the growth was more the impact was felt from the middle of last year, in the second half of last year, and that growth momentum is going to proliferate into much of 2021. In fact, for 2021 over 2020, we are looking at doubling of EPS for a lot of the large glove players, because the ASP momentum is still strong. Pipeline orders stretches all the way up to the end of this year. Cases are still worrying, so I think the long and short of this, I think in the short term at least, on a trading stance, rubber glove sector is a buy to us, and the third source of growth for this year would be utilities, and that will be anchored by Tenaga. Our utility company Tenaga had a bad year last year because excuse me, they were saddled by a few unforeseen expenses related to social assistance programs, things like discounted electricity rebates for the B40 market and so forth. But this year, that expense will be a lot less. And finally, the fourth reason is because we believe that Genting Berhad and Genting Malaysia is going to turn around this year. I think the Singaporeans like yourself will know that Genting Singapore had a very good first quarter, I believe. And I think Genting Singapore is going to be the drive engine for Genting Berhad. So between Genting Malaysia and Genting Berhad, we prefer Genting Berhad. Genting Malaysia, the situation here is still very dire because there's an MCO here. For you might have read, it's now extended nationwide except for Sarawak. So we can't go up the hills, and yeah, there's going to be another quarter, if not 2 quarters of losses. But I think it'll turn around in the second half. 1711, that's our KLCI target. Okay, we arrive at this number by applying a PE multiple of 15.7 times. This is a forward price to earnings ratio, right, on FBM KLCI's EPS of 109 cents in 2022. My team of analysts have projected 109 for the 30 KLCI stocks, and that gives us 1711. Why 15.7 times? 15, excuse me, 15.7 times is a slight premium actually to the 10-year mean. We looked at the 10-year mean forward PE for the CI and realized that the mean rests around 15.3 times, and 15.7 times is half a standard deviation above that. And we believe that this premium is justified because at this point in time, we are operating in a very low interest rate environment. Cost of funds are very low, and so it doesn't take much for investors to move from cash to something more risky. So they are willing to apply something higher in terms of multiple. Instead of what is usual, 15.3 over the last 10 years, they might give something closer to 16, for example. And 15.7 times reflects a risk-free rate of 3.1% in Malaysia. The proxy for risk-free rate is our Malaysian government bond yields, 10-year yield, which today is at 2.6%. When I was doing this slide, it was 2.7, so it's gone down a bit more. So what we're saying is that we are applying a safety buffer of 40 basis points. I think we'll be accused of being very aggressive if we use 2.7 and tell you that it's 18 to 25. But we've been a little bit more careful. We are building in a 40%, sorry, not 40%, 40 basis point buffer to the risk-free rate to arrive at the 15.7 times. And this 40 basis points buffer, I think is also appropriate from the point of view that the yield curve is likely to steepen close towards the end of the year, because as economy recovers, the 10-year bond is likely to also move up, to reflect an improving economy. So and just to give you a sense of how changeable from one year to another is the MGS 10-year yield. So I've got this chart here showing what the variations from year to year over the last 10 years. And the last GFC, we saw swings of about 100 basis points. But after that, it's been a lot milder. So, it's between sort of 5, 10 basis points to 40, 50 basis points. And we're just saying 40 is, we think 40 is actually a very comfortable zone to be building a buffer. So yeah, I hope that gives you some comfort on our computation of 1711 as a target. What about, that's about a top-down approach to valuing the target CI. But what if we do a bottom-up approach, okay? Now, you know that there are 30 component members of this KLCI, and we know the index shares that the index constructors use to arrive at the KLCI number. So what we've done is just our analysts have a target price, year-end target price for each of these 30 stocks. We plug in those numbers and we arrive at 1773.64. So 1773 is a bottom-up derived target for the KLCI. So we are quite comfortable that the market could reach 1700 by the end of the year. Okay, let's move on to themes I talked about earlier on. the first one was liquidity. Liquidity is ample. I say this with confidence. Last year, liquidity was unleashed by the central bank when they cut the SRR from 3% to 2%. But effectively, they're cutting it down to zero because they allow banks, right, to uh, to count the investments in MGS and the Islamic government securities as contribution to SRR. So what a lot of banks did was that they just used whatever cash they had, idle cash, and then just buy into the bond market. So there was a lot of money released, and then not only that, the central bank also cut OPRs. They cut by 125 basis points from 3% to 1.75. Today is another decision day, which we believe they'll cut again. So a lot of money was unleashed. That was helpful because last year uh, the market was up in no small way because of liquidity, and then we had a very good retail market driving up the market in last year, especially rubber gloves and technology and small caps. This year, we think that the liquidity force is still with us, despite a lot of um, pushback and concerns that you know the major source of liquidity in the past has been like our pension funds, ETF, Q12021, and these institutions are very important because when foreigners are not interested in Malaysia, who buys them? The big buyers are ETF, Q12021, the GLC funds, and besides our private fund managers. The problem is, starting last year and also this year, some of these pension funds are cash challenged because maybe I show you this slide. The cash challenged because we've got a lot of schemes in Malaysia that was introduced in a budget and stimulus to help alleviate the suffering of the common man in the street. Really this to lighten their cash flow burdens. So as a result, starting last year, the government allows what we call I-Lestari account 2 withdrawals from the EPF. And then the budget in November expanded this to include what they call ICNR. That's getting your hands into account 1. Basically a cash advance of up to 5,000 or even up to 10,000 if you've got more. So they are opening basically your savings, your retirement savings for immediate use because of the dire situation that some of us may face. Then not only that, then you have what about job cuts, wage cuts, things like that. Also reduces the the contributions of the members to EPF. So basically, EPF was squeezed on both ends. The revenue came down, not revenue, I mean the income, the contributions came down, and then their withdrawals went up. But the long and short of this is that, yeah, you see the net inflows into EPF falling a lot. But what we are saying is that we try to address this by telling our investors, clients that this is, while this could be a concern because you do lose a captive investor, but remember there are other owners of capital that could put the money into use. What I want to show you here is this, on a point of liquidity. Okay, I think this is an interesting chart to look at. M1, as you know, M1 is easy money, right? Money in currency in circulation and also demand draft, right? Now, M1 increased by nearly 70 billion last year after the SRR was cut, OPR was cut. So the base M1 increased to 520 billion at the end of last year from a base of 450 at the end of 2019. And to have 70 billion increase in M1 is a very, very rare occasion. We have not seen this kind of increase for a long time, if ever actually. But so you have 520 billion in the banking system, M1. And then because last year was a very slow year, we had a contraction. We are forecasting a GDP contraction of 5.1%. And That we deduce from that kind of economic activity and M1 supply, your velocity of money is only 2.75 times. Money is circulating very slowly within the banking system. If you look at the past, this orange line here, velocity of money has been as high as 4.2 times or thereabouts after the GFC last year. And then we would say that in a normally operating economy, right, your velocity should be around 3.5 times. That's neither overheating or underheating. But right now, what we're saying is that 2.75 times, the monetary system there's a lot of slack. Money is waiting there to be used. For example, if you just assume a one-time multiple increase in the velocity, yes, what we're saying is that you have 520 billion of money there ready to be used, to fund things like your capital formation, your consumption, things that will, increase economic activity. So there is a lot of money, though it may not be the pension funds, but for example, banks, if banks can't lend out, what do you do with the money? You put it into MGS or some kind of safe security will give you some yields, right? So in that sense, we think that the bond market is going to be okay. So there's liquidity in the system, okay? So not to worry about the cash situation of the pension funds. The second theme is foreign interest. Now, the foreign capital flows have been a mixed picture in Malaysia. The bond market has been okay. Last year, we were recipient of foreign money into the bond market. So was 2019, I believe. Yeah, it was only 2018. It was probably a bad one because of the change in government and people were not really quite secure about it. But last 2 years have been fine for the bond market. We think that 2021 foreigners will continue to put the money in the bond market in Malaysia. So that's another source of liquidity. Yeah. And we are quite sanguine about prospects for the bond market. The reason why I'm talking about bond market instead of equity markets is because the bond market yields is relevant insofar as the risk-free rate is concerned. So as you know, risk-free rate does have an impact on the P multiple that we use to value the equity market. But I think what is very encouraging to note was that last year, on the 4th of December to be exact, Fitch downgraded Malaysia's sovereign rating from A- to BBB+. The initial reaction was negative, obviously. It was just knee-jerk. Lasted 2-3 days. Suddenly, you get the yield spike in the bonds, 10-year bond. But since then, the yields have been trending down nicely towards the end of last year. And early this year, it spiked up a little bit, and only because of the steepening yield curve in the US Treasuries. So if you look at this kind of yield trend post the downgrade, you must say that it's a quite resilient market against that kind of headwind. And maybe the other reason to explain this is because the yields that Malaysia bonds can give foreigners relative to the US Treasury is still attractive. It was obviously at its peak in March last year when COVID fears was the most frightening. But after March last year, as the pandemic sentiment kind of subsided, the spread started to fall. But even at these levels, lower levels compared to last year, the spread is still higher than where it used to be before the change in government, right? So I think hopefully when we see more stability on the political front, this spread could even come down more. Foreign fund to return to Malaysian equities, that one is something that we cannot say is impossible. I think it's we'll put the chances more than even that they will come. If you look at over the last 7 years, right? In 6 out of the last 7 years, foreigners have been withdrawing funds from Malaysia. Only in 2017 was there an inflow. So is that bad? And if you look at the this chart here on the right is what I want to highlight. The the um, the blue line shows the percentage of uh, KLCI stocks, right, in aggregate that foreigners own today compared to 5 years ago. 5 years ago, we were about 18% of our bellwethers were held by foreigners, and that's now down to closer to 13% only, right? So that's quite bad. And then also, talk in terms of the top 50 as well, we've been actually at quite low levels. So it's like saying, the foreign interest exposure has dried up quite a lot. Emerging markets is in fashion these days because, and it's a consensus view that emerging market is now looking very favorable among global investors because, with the onset of the vaccine making its impact felt, with Biden coming into the picture, prospects do look better for emerging markets. So we saw emerging markets started to outperform late last year. But you look at the last 5 years, how MSCI Malaysia, the green line, performed relative to MSCI emerging market. The performance gap, right? The underperformance is so obvious. It's actually, when you look at this chart, you have to consider, is there a lot of value in Malaysia? I think that's a key question we have to sort of address if you are a global investor. And then you look at KLCI versus the ASEAN peers over the last 10 years, right? You look at how much each market returned in US dollar terms on an annualized basis. Malaysia gave you 1.7% in US dollar return a year in the last 10 years. Singapore is slightly better, only 2.4%. But the best performers were Thailand, Philippines, over 7% return. Again, Malaysia is a very deep laggard here. And I could go on and on. The PEs also have been derated. So what we're saying is that it's time that I think foreigners will probably look at Malaysia and say, hey, if the political situation improves, we are seeing a broadening of investment opportunities, and stocks are very undervalued. And don't forget this also, I think generally the narrative about investing has turned from go for growth and safety last year into something like go for value and go for cyclicals, right? So Malaysia is a value market. If you want to look at Malaysia in terms of halves, which half will be better, our bet is probably second half. I think this quarter, as I say, I think the bank's picture not so clear yet, but we have an optimistic view on the banks actually, but that view will probably be clearer later. And then near term, we're struggling with high daily cases. We've got an MCO now in operation, and so the finance minister is just quoted in the press today saying that it's costing Malaysia 600 million a day. And as a result, I think brokers have started to cut GDP expectations. So, yeah, I mean, the sentiment is a little bit not so good at the moment. And then there's also anxiety over the timing of snap elections. We're now in an emergency situation, but actually things are not as bad as it sounds. Emergency is not really a bad word here. I mean, it's business as usual. People feel safe. You go about doing your daily life as usual. But it just means that the government is more stable until August, I think, where the emergency status may have to be reviewed. But I think it will take a very good conclusive election to actually lift Malaysia above where we are today. Let's see what happens now. But we reckon that elections will probably be late this year because you have to have the pandemic ease sufficiently so that we're safe to vote, right? So maybe it'll probably be in the second half of the year. And also, hopefully by middle of the year, we get better news from the Western markets in the form of lower cases. I think US and UK is still very worrying in terms of numbers. But offsetting all these bad stuff, right? We have good things being done by corporates here. Some corporates do the sensible thing. They're actually buying back shares in the market, especially the rubber gloves counters. This has the effect of enhancing EPS. Hopefully, some of these numbers will come in better than forecast. And our next vaccination process is going to start next month. So I read that by the end of the year, we should have something like 60% of the population being vaccinated by then. So hopefully we get some semblance of herd immunity in 2022. So lastly, in terms of themes, the last theme is actually sectors we like, which are the COVID victims of last year coming back. Construction is one we like a lot. I think construction is one, the Prime Minister will have to do election later this year, and I think it will be in the interest of the current administration to try and help the economy, try and generate activities for the economy. And one of the easier, low-hanging fruit to pluck would be construction as a pump priming tool for the government. We're not saying that the government start dishing up, projects to contractors, but rather speed up whatever that's being developed today. Things like the LRT3 or even the MRT3. A continuation from MRT2, and then we have the likes of the renewable energy projects. I'll show you more of this slide later. And then we have also the sin stocks. The gaming and the brewery. Gaming would be Genting, of course. Last year was a really, really bad one. I think for 2 straight quarters, Genting Malaysia reported losses, not just local, but the New York casinos had to be closed, impairments impacting the P&L, they were cash flow deficit and things like that. But going forward, I think things are better. They've decided to cut losses in UK. I think New York will turn around, and so will Malaysia probably towards the middle of the year. But Genting Group is leading the pack up, thanks to Genting Singapore. And then brewery, again, I think what was very disappointing last year, and I'm talking about Carlsberg. Carlsberg has been looked upon traditionally as a dividend giver. But last year, for the first time, I think the first time ever, they decided to suspend dividend, much to the disappointment of a lot of investors. So I think this year is highly likely that they will start to restore dividends, and that will be the catalyst. I think for breweries, the problem was a lot of the hotels and the restaurants, coffee shops and stuff were affected last year. So yeah, it doesn't take much to imagine that things will be better when the pandemic subsides. Recommendations for 21, we like automotive, construction, gaming, rubber gloves, technology, and utilities. Right, so that's the sector stuff. I've got about 5 to 10 minutes left to cover some sectors, so maybe I quickly go through some slides. Okay, construction. What I want to highlight here in construction is that we sense that there's a lot of deep values in a number of names, and in Malaysia, if you look to us as a value destination, and within this destination, value sectors, it will be construction. And here I want to demonstrate why 3 names are very, very close to trough valuation. You look at the price to book valuation over the last 15 years, Like for example, HSL, Hawksingly is 0.56 times, right? Kerjaya Prospect 0.96 times, Suncon was 2.6 times, the lowest of the last 15 years. And we have the book value per share for each of these three. You multiply the lowest and see where they are. For example, HSL, no, 0.9, 90 cents is trading at 96 cents. So if you buy at 96 cents, your downside is only 6%. And the upside could be a lot more. Kerjaya, and the trough valuation is 92. It's trading at just over 1 ringgit. At worst you lose 8-9%. Suncon, a very reliable name. 160 was its trough. It's 170. The downside risk is 7%. So there's a lot of deep value. Of course, the others have gone up a little bit. I mean, Gamuda is one we like as well. But if you're very conservative, there's a downside risk of about 20%. George Ken we don't really like, but yeah, these are some of the names that we can throw up as a recommendation. Yeah, I think a catalyst for the construction sector would be activity coming back in a big way. LRT3 has been a sore point last year for the sector because when the Pakatan Harapan took over in 2018, they renegotiated the value of the contract down by quite a lot. And MRCB, George Ken were the turnkey project leaders in LRT3. So they had to take a lowered price, and then after that they had to renegotiate with their subcontractors to lower the price. So that was a source of a lot of tensions and disagreements. You can imagine there's a lot of people in the party. So it took them nearly 2 years to finally get it settled. So last year, second half, they managed to agree to the reduction date. So for March of last year, people like MRCB and George Ken were actually doing work and not be able to reflect the value in the form of profits into their P&L, because you can only recognize profit when these agreements are finalized. So finally, those agreements have been finalized. And in terms of the percentage of completion, the project's about 40% complete. So we expect for 2021, some of these profits that were not recognized last year will finally show up in the P&L. So that would be a source of earnings growth for them. And the other thing to highlight would be not just LRT, but property as well. Last year, because of the severe lockdown, a lot of launches were held back. So speaking to some of the property developers, they feel a bit more bullish this year. So they are going to launch more projects. So that will be good for the building contractors as well as the building material people. So Kerjaya prospects tend to benefit from here. We believe that the small caps will outperform the big caps. In a liquidity-driven market, the tighter floats will obviously outperform. And oh yeah, one more thing that we would like to highlight, this is one where Kerjaya prospect also could be a beneficiary, is in large-scale solar power projects, right? There is an agenda by the Malaysian government to increase the mix of renewable energy from 9% currently to 20% by 2025. So we estimate that as much as 1,200 megawatts of large-scale solar needs to be built and developed within or awarded within 2021-23. Yeah. So these are some of the projects that will catalyze the sector. And technology, if I can just quickly go through, we are very excited about technology. It was a great performer last year. It will continue to perform. It's a circular growth story. Several drivers there. I mean, 5G development, base stations, smartphones. We're hearing iPhone 12, certain models are actually out of stock. Nintendo Switch, in big demand. Work from home, that drives the demand for laptops, PCs, and cloud computing has also increased demand for enterprise disk drives and power management chips. So all these actually making the wafer foundries very, very busy. And you wouldn't have imagined last year that something so archaic as 8-inch wafer capacity is being squeezed dry. They're all operating at 100% capacity because demand went up. They were underinvested last year, so there's a catch-up play here. And the one that's benefiting from this would be in Malaysia is this um, company called Kellington Group, KGB. My analyst has just raised the target price to 310 this morning. Very excited about applying 30 times PE. Very excited because they got new awards from SMIC uh, to supply the UHP, ultra high purity gases. They also provide liquid CO2, and they've got new orders from Singapore for liquid CO2, which um, they used to operate at 50% utilization rate. Now it's gone up to nearly 100%. So at least for the next 3 quarters, the earnings are coming through. Yeah, the other play would be on car sales, especially in China. As you know, cars are becoming more electronic in nature. I think the contents of electronics in cars have really shot up. And here in Malaysia, they do sell LEDs and electronic components of cars to China and Europe. Europe is looking not so good, but China is picking up. So the place there will be DNO, MPI is becoming more car-centric, as well as KESM. But KESM is gone up too much already, so we downgrade to market perform. Yeah, I think that really is about it. Rubber gloves we like also. We think that, okay, just in a nutshell, rubber gloves, the ones that spread doom about rubber gloves is saying that um, ASP, average selling price, will crash to 35 US dollars, at the start of 2022. So we defer. We are looking at something closer to 450. But okay, let's throw our hands up and say, if it's 35, what does it mean for net profit of the big four that we follow? Top Glove, if you have 35 ASP, they will generate net profit of 4 billion ringgit. And our analyst thinks that 4 billion is, you apply a mean, this is just mean PE of 17 times, you get 833 as target price. Share price is now 615, so there's a lot of upside. Harta Lega, 35 ASP, they can generate 2.6 billion. Apply at 25 times mean is 1925. Share price is 1210. Kosan, 1 billion. You can get 663. Share price is about 420. Supermax, 35 ASP, net profit 1.5 B. Indicative target price is 825. Share price is now about 6. Right, so ample upside, even if you assume very, very bearish assumptions about average selling price. I think I've come to the end of my presentation. Time is up, so I'd like to open the session to any questions that you may have. Let me look at yeah. Okay, let me read some questions. Okay, the first question is, will the state of emergency impact foreign funds from investing in Malaysia? Not necessarily in a bad way. Okay, I remember this episode very well. In May 2015, remember before that Thailand was in a really bad shape, right? When there was red shirts, there was yellow shirts. There was so much uncertainty in the country, in the market. Things weren't moving in Thailand. And when General Prayut forced his way into office, right, in May that year, I believe, basically ousted Yingluck, and it was done in like a emergency condition. Remember those days. And to everyone's surprise, instead of foreigners running away, they actually piled into Thailand. And let me quote Mark Mobius that during that time, he mentioned something like, you cannot expect a stable elected government in that country or in that market. And what foreigners want is certainty, right? And you look at the chart in SET, after that, it was just all the way up for, I think, 2 years. So emergency is not necessarily a bad word in my mind for a developing country, because if the emergency serves to bring stability, I think investors will be relieved. Actually, on the ground, the business people will be relieved, because you can't really operate at peace if you worried about Muhyiddin being toppled the next day, or that kind of thing. So I think it is not a bad thing. One hopes that in the lead up to the elections, the current administration will do all the right things, and whoever emerges after the election will be a government with a more convincing mandate. I'm not talking about 51% majority. Maybe hopefully can see something closer to 60%. I think that will really work out very well for the country. So uh, the next question I can pick. Let's see. Um, Sorry, there's a question on how will the performance of utility counters for year 2021 MFCB. I'm sure we don't cover MFCB, but I suppose in short, I would like to say that we are maybe on others like TNB, for example. There's another question on TNB. Our target price for TNB is $13. Yeah, 13 ringgit. But um, I think, okay, utilities, we like TNB because it is actually a regulated business. Um, you know, uh, 2/3 of its business is actually regulated. So things like um, volatility of fuel costs actually can be passed down to consumers. So they're given actually a fixed kind of return on assets invested. So if you are a conservative, you want certainty, I think TNB offers at least a semblance of that. And also at this current price of 10 ringgit, right? It gives you a dividend yield of 4%, which is higher than the KLCI, around about 3%. And also PE wise, TNB is in the low teens, right? And KLCI is about in the 14, 15 times if you look at it in terms of forward. So TNB would be a dividend yielder with some value, with a lot of value. And the other utilities like Petronas Gas also are, you know, well governed in terms of the earnings, because they are all under regulatory framework. So yeah. Okay, there's another question on please advise the Top Glove long-term performance, and it seems affected due to COVID very badly. Long-term performance, I'm not so sure about it, but I think if you're investing for 6 months, I think the safe to say that the downside from where we are, 620, is very low. I'm quite confident of Top Glove actually. If I can show you one more slide. Actually, how do you share? Okay. Can't do that. Can you see? Huh? Can see. All right. Sorry. I need to scroll it down. Okay. Sorry. I can't move the slides. But on Top Glove, right? One of the concerns. Well, we're only like 3 weeks in February, but into January. Sorry. Was over the actions of short sellers. Last year, the Bursa Malaysia suspended short selling to protect the downside to the market, right? And they lifted it January 1st. And guess what? The biggest target for short sellers were Top Glove, Harta Lega, Kosan, Supermax. I mean, there were so many bears, out there that they were shorting like crazy. So the biggest shorts were done on Top Glove, and okay, I've been following the activities of the short sellers day by day. So sort of year to date, I mean, the first 20 days of January. And right now, the net short positions of Top Glove, there are about 250 million shares shorted since 2nd January. 250 million is about 2.8% of the issued shares. Now, there's a ruling by by Bursa, right, that the shorts can only reach a limit of 4%. So if you're a short seller, you can at most short sell 320 million, up to 320 million shares in Top Glove. They already sold 250. That means that they've got only a room to short sell 70 million more, right? Before that ceiling is reached and you cannot short sell anymore. If you are now on the 2nd of January, 106 million shares was shorted. Then you've got only 70 million left to do. So if you're a short seller, I don't think you're going to short anymore because how are you going to cover? And that's point number one. Point number two, for the first time this year, there was short covering already. Yesterday there was numbers showing that the short covering started to come in. So if you're worried about tactically the short sellers as a source of supply or selling down, I'm quite sure that's not going to happen with Top Glove. And I showed you earlier on that even if you assume $35 ASP, Top Glove can deliver 4 billion ringgit. And based on just applying a mean P, the target price is 833. So share price is only 620. So that is quite comfortable. And right now I suppose you have to look at. I think it's what is pulling people back from being more aggressive on Top Glove is they say the vaccine will work at some point. It will work. Then you got to ask yourself, yes, vaccines will work, but will people, having gone through this bitter experience, right? Will people just throw caution to the wind and say, let's forget about protection? I think people will still be very, very vigilant, very, very conscious about being infected again. So I think we've reached a point where increased glove usage, masks, is becoming kind of like, I won't say a way of life, but it's going to be something which people will use more of. So I'll stop there on the glass. So I think I've reached the end of the line. 1:30 is here. So I think, Alina, I will stop here for you to come in and say any concluding remarks.
Yeah, okay. Thanks, Mr. Koh, and thanks everyone for staying through this session. So I think we have come to the end of the session. So if you have any questions or feedbacks, to drop us an email at talktoglobalmarkets@phillip.com.sg. I'll be sending the email address into the chat box later. Yeah, and I think that's all for today. Thank you everyone and have a good day ahead.
Okay, thank you, Elena. Thank you, everyone.
Thank you. Thanks, Mr. Koh.
Thank you.